All right, I'm going to stand because it's been a long day of sitting already. So feel free to continue to stand if it makes your legs feel better, since a lot of you came in on probably an overnight flight or a late flight yesterday. So first of all, I just want to say thank you for having us. This has been humbling and hugely educational. I'm really afraid to open my mail now for the legal and financial services bill that's probably waiting given the hourly rates of most of the people that spoke today. But hopefully they take Bitcoin and maybe that'll work out. So what we're going to do in this session is kind of unpack. We've been talking about ICOs sort of as a generality today. And so we're going to unpack ICOs a little bit. Certainly with anything new, there's good players, there's bad players. The three that you'll hear from today are good players, I think. So you can decide if you agree with that. But I think they're doing the right thing with blockchain and some really interesting and exciting and novel use cases that we'll go over. But just to start out, can I do a show of hands? How many people in the room are investors? Can you raise your hand? Okay, it looks like about a quarter. And this can be multi-select too. How many are attorneys or work in law? Okay, about another quarter. Government, regulators, a few, okay. And the others that aren't raising their hand. How about technologists, entrepreneurs? Okay, about a third, I would say there. So, and just out of curiosity, has anyone written their own smart contract or done coding work related to the blockchain themselves? Okay, yeah, it's the people I thought. Good. All right. Well, this is, I think, a really special event, and the reason is, Sarah Hanks this morning talked about this being the intersection of cryptocurrency, security, sort of colliding, and I would go a step beyond that to say this is one of the few times where in the world, San Francisco, which is where this group is from, New York and Washington, D.C. kind of all collide, and I think even beyond that, cities like that, so really meaning technology, finance, and law and legal, and the opportunity to work together on something as meaningful and world-changing as this, I think, is pretty amazing, and it's also one of those cases that none of us can do it by ourselves. So we have to work together to make this successful. So I think that's a very special thing. The turning point for me personally in having watched blockchain for a long time was as an advisor at StartX, which is Stanford's student accelerator, and the venture studio at Stanford's Graduate School of Business. When Goldman published, they shared some CB Insights numbers showing this summer that ICOs had surpassed early stage venture investing. As a venture investor myself, that got me interested, and as a technologist, that got me very interested in sort of the opportunity. So we're moving from this being sort of a sidebar thing to something that's going to impact all of our industries, which obviously is what brought us all here. This summer, the raise of Filecoin, which is a Stanford company, caught a lot of attention. Right now, those events are sort of huge and make up a lot of the numbers, so it's important to sort of unpack those numbers as you're looking at them and think about, is there any double counting going when people are investing and then liquidating and investing again, and other things that could be making them not apples to oranges comparisons. But the way I look at it, sort of from a valley, maybe a valley-centric view, how many people have been to Sand Hill Road in Palo Alto? A few people. So Sand Hill Road is where a lot of the big players in venture capital have their offices. What people a lot of times don't realize when visiting is that half of Sand Hill Road is Stanford. So everything as you're driving out towards 280 on the left is all Stanford, starting with the shopping mall and ending with the Stanford Linear Accelerator. Everything on the right is venture capital all the way up to the Rosewood, where Andreessen Horowitz sits across the street from Sequoia Capital. So the community is very important, and over the course of the 7 years of StartX, there's been over 300 companies that have come through. Collectively, those companies have raised $2.9 billion. There's a Stanford StartX fund now that invests on a trigger-based investment in those companies. And so there's a lot of activity that's happening, and that's done through a very specific and well-designed network of founders and investors that have come to trust each other in various deals and in various companies. What we see in blockchain is the capability to take analog trusted networks like these and convert them into digital digital networks that can then scale and enable companies to do more faster, and also to unlock some of the opportunities that traditionally have been sort of locked into these closed networks. And so we look at blockchain fundamentally as an opportunity for new ways of investing that empower entrepreneurs. And so the fun thing about today is taking sort of the scrappiness side of being a startup founder, and also looking at sort of the regulatory side and bringing those two pieces together. And that's been a real learning point for me getting into this, is that the design of the token and the design of what you do in an ICO, and more importantly, what you do after an ICO, is really defined by the market and defined by the context that you operate in. So that's kind of what we want to talk about today. I'm currently working on a project called FounderBit. I'm not going to talk about that. We'll have some announcements, pretty exciting, at the end of this month. But for now, if I could ask you a favor to go to founderbit.com and put your email in, then you'll be on our list, so I don't have to talk about it right now. So I want to just set up the conversation, and I'll stop talking and let the founders speak around this concept of value. And fundamentally, we've sort of developed a hypothesis, which is based on what we've kind of always done in our community around the value of the trust underneath sort of the transaction, and the value of what we're doing with blockchain over sort of the speculative sort of nature of what you can do with an ICO. And said another way, you could say this is a new way of doing the same old thing. You bring together investors, you bring together capital, you bring together people with ideas about growing new businesses, and you give them a way to transact. So sticking with sort of that model, we have some founders who are doing some exciting things. So I'll stop talking, and we'll start with Ben. And if you could just explain what your project is, any numbers that you can share, and just sort of a brief background, that would be great.
Sure. Hi. So I dropped out of Harvard, did a TL fellowship, and we started a company called Stream. And Stream is making content creation profitable. And yeah, so I think one of the most interesting things is now we're seeing, for possibly the first time, right, a very clear intersection between technology and finance and money. And when you are able to create and control your own currency, you can align incentives in such a way that you can create an economic world for a lot of these products and services in the technology industry that have not been possible heretofore. So for what we're doing, for example, we're aligning incentives between content creators and content platforms like YouTube, Twitch, Periscope, where today, these platforms are taking a 45% cut or 40% cut. And that's because they have fundamentally misaligned incentives, where ostensibly they have to work together, but at the same time, they're both trying to fight over the same zero-sum economic pie, right? Any money that a content platform takes has to come directly from the pockets of a content creator. And so they're both trying to, try to get as much economic leverage so that they can take as much of that pie as possible. And so that leads to kind of these terminal states that are just very negative for one party or another, right? And so right now you can see content platforms are winning. They are becoming monopolies, right? And with monopolies, you're able to have this kind of extortionary economic leverage. But to date, there has been no way to kind of defeat this, because what you can do if you're going to compete with YouTube? Well, you just create another YouTube, right? And maybe you're price competitive at the very beginning when you're not a monopoly yet. But the end terminal state, how do you make profit? Well, any company today that is a for-profit company is valued based on how much money you can take as profit, right? And so tautologically speaking, all you can do in that case, right, is try to milk this cow as much as possible. With a blockchain technology-based model, you can actually fundamentally change that. You can create a company that is for profit, that isn't necessarily actually something that wants to take a transaction fee. In fact, you can design a system in which that company takes as little of a transaction fee as possible and still be totally self-rationally interested in its own success, profit-wise. So we can talk about that a little more later, but that's what we're working on.
Cool. That's awesome, Ben. Everyone, I'm Mike. As background, I was a investment banker at JP Morgan and Citi for about 9 years. Structured all kinds of weird securities like CDOs, ABS, any other acronyms. And then about 7 years ago, had an epiphany that probably wasn't what I wanted to do with my life. So I moved to Silicon Valley. Entered an engineering program at Stanford after 9 years of banking. Spent a lot of time in the library, learning to code. And then eventually started a company, sold it. And then my new company is called Coin Alpha. So Coin Alpha uses a blockchain to reinvent how securities work. Our first product is a hedge fund that's entirely blockchain native. So there's no administrator, there's no auditor, there's no accountants. It's simply us, our investors, and the blockchain that intermediates transactions logs all events onto the blockchain and handles like NAV calculations, subscriptions, and redemptions. So our thesis generally is that because the blockchain is a single source of truth, instead of having every market participant build redundant systems, siloed data structures that are error-prone and inefficient, the blockchain just makes that all go away, and the future of securities will all be blockchain-based. So after a hedge fund, we'll launch additional fund products, and eventually other securities like derivatives, ABS, and all the stuff I used to structure back in the day using the blockchain.
Sweet. Yeah. I'm Shane Walker. I graduated Stanford 12 years ago. I've formed 4 companies. This is my most recent one. Some have been venture-backed, some haven't. We raised $5 million from traditional venture capitalists before we started doing our own token at the start of this year. We invested in Bitcoin really early, and then my co-founder invested in Ether, Litecoin, a number of others. Sort of the tide turns, and you start realizing where the action's going. So we run me.me, which is the #1 meme search engine in the world. If you don't know what a meme is, ask your kids. It's roughly like Giphy or YouTube, but it's more popular, it's bigger, it's faster growing. Why are we not building the next Giphy? Because honestly, tokenizing creative assets, making a fungible community for creatives is a much more interesting business model than selling ads down the road on Madison Avenue. And I would say most VCs would agree if they were to be honest. And also, I'll just comment quickly, you guys should really take a look at some of these smart contracts. The difference between a currency and a commodity is literally one value in some of these contracts. So like watching from the sidelines is almost unacceptable when it's that easy. A lot of their prototype contracts look right now. You can define the differences, and talking about the nuances in the abstract seems irresponsible. I'll put that out there. I've been doing this for a while, and it seems unnatural that people are so hands-off from something this straightforward. It's JavaScript, and they're open templates out there. That's it. And yeah, we're raising a token, obviously, but I'm going to be careful with my words because there are regulators here.
We'll get there. Don't worry. Don't worry. So,
Oh,
and it's
we're
being
recorded.
recorded as well.
We're
Yeah.
recorded.
So let me ask you a question, Mike. Given you have a background in Wall Street and traditional finance, the title of this session is called ICOs Continue Now Institutional VCs Are Taking Part. And if you look at the history of venture investing and even hedge funds, these were kind of the newcomers to the equities game, which now people think of as traditional money. As ICOs come in, one of the things that we've seen as VC has become sort of a more standard investment vehicle, that these things are incredibly mature, and in turn, VCs are looking for companies with more traction, more experience before sometimes even doing a seed or especially a Series A. What in your opinion, since you've seen sort of both fields, is the differentiator that as of October 2017, November 2017, we're seeing traditional investors, or we'll call them traditional, but institutional investors wanting to get involved here? Is it strictly based on the hockey stick, or are there other factors here that have changed the nature of the wallets that are making investments?
I think with every new asset class, a hockey stick curve always helps. But ultimately, I think what's different this time around is that this is a financial innovation as much as it is a technological innovation. For those who are unfamiliar with how smart contracts work, they're basically code that governs the flow of capital with logic on the blockchain. So, of course, that means that you can, move kind of like bitcoins around, but you can also do things like say, only pay Bob bitcoins if both Alice and Eve both agree, and if the value of Bob's asset is more than X. And so that ability to have a Turing-complete programming language associated with transactions is a game changer, not just from a from a technology perspective, but also in terms of financing, because all securities are essentially just legal agreements between different parties, and the ability to deploy them on the blockchain, I think, is a true game changer. So when I think the reason that funds are interested is not just because they see the value of the technology, but also because taking that thesis to the end state, why should you have a traditional VC fund? Why not just have a smart contract governed by the crowd or a professional manager that is deploying capital via the blockchain?
Mm-hmm. let's do some myth busting, because I think from the outside, and I might have to cast myself in this space as well before I sort of got educated. There's this viewpoint that this is easy money. You know, if you think about the traditional fundraise and going, office to office, both in our area but also all over the world in order to close a round, versus throw up a smart contract, write a 3-page white paper, put up some headshots and call it a day and watch the money flow down. And just as background, there were originally 6 people on this panel, and two of them pulled all-nighters last night and couldn't make it. They're still working this morning on their ICO. The third has the flu because he was pulling all-nighters and raising a $100 million ICO. So can any of you give some war stories or offer some perspective on the difficulty for founders in one model versus the other? What makes it better or worse?
Yeah, so I can take a first shot at that. And unequivocally, I think this has been the hardest thing that I've done in my life, right? All trajectory fronts. So, I've raised traditional capital before, and it's not even, it doesn't even touch kind of how hard and difficult it is to raise money in this realm for this particular kind of product. And the reason for that is you have so much to do on all these different fronts. There are 3 major fronts, right, that you have to tackle, and one is technological, of course. Then there's also the actual legal aspect, which is just like this huge uncertain ground right now, right, where we've paid maybe $200,000, right, for legal fees. We've had to work so close with our lawyers in a realm in which, like, a normal financing thing is like, what, you pay $10,000 and you get it done, right? It's like a 2-week process at most. And then you have the actual outreach, right? You have the actual public outreach and letting people know what you're up to and all that. And you have to do all these in a world in which basically any misstep that you make on any of these fronts is kind of a very large problem, where normally in, say, web development and all that, right, you have this like move fast and break things kind of philosophy. Whereas in this case, right, if you move fast on the tech side, right, you lose like your $30 million, right, which has happened many times. And if you move fast on the legal side, right, then you misstep the realms there. And if you don't move fast enough on the public side, then you don't manage to make this work. And so it's it's incredibly challenging. And at the same time, of course, there are large rewards for doing it correctly, because it is a nascent field, and it's exactly what we see every single time we have some kind of technological leap, right? Like, this is exactly what the internet would have been like back in like 1994, right? Before there was any strict regulation or any strict clarity around all these things, or back when computers first started becoming a thing. You could see this kind of like same trend play out over time, where at the very beginning stages, right, there's massive reward, but also massive work to make it happen.
Yeah, I'll give some hot takes. I've been doing these talks for a while now. So we, as ICO, so new report, most entrepreneurs make below $6 an hour while struggling to raise their businesses, the successful ones you guys hear about. So entrepreneurs live a hard life, as you guys know. So the typical trajectory is already tough enough. And then this year, I've heard us compared to communists, to people breaking into cars, to people who are trying to rob your grandma. So we're fighting perception. We're fighting an already hard life. And then on top of that, the investor class that we're talking to are not, they're different than VCs. Most VCs cannot even act in this space. They'll tell you no, but reality is their LPs won't allow them. So put most VCs aside. The actual investors in the coin economy are very smart engineers who invested early on in Bitcoin. And those guys are not fools. Those guys are very smart. Those guys know math very well, and they can read the smart contracts and see what you're doing. So the action is very different. Actually, the real hard raising is done with engineers and talking, because, like you said, 10,000 holders control the majority of the Bitcoin gains in the last year. So these conferences are good to kind of educate the overall market, but the actual, it's very hard. It's very hard. They're in forums. They're anonymous. You have to sell them on your logic, on math. And then on top of that, we could all go to jail if we do something wrong. Like, this is a hard life. And like, I know it sounds like a cash grab, but the ones who make it out without breaking the rules, or by complying and making the rules, like, it's definitely the hardest thing I've ever done. Much easier than a safe. So why would I do this? Because I think it's legitimate. I think it's unfortunate the perception is we're all just making a ton of money and running away, because this is the most expensive thing I've ever done, and by far the most risky thing. I can go to jail if I do something wrong. So that's it. I love building tech, and I would say the atmosphere seemed to turn against the entrepreneur, like to try to protect regulators, when in reality entrepreneurs have been assaulted the entire time. It's a very dangerous path for all of us. So that's it. It's tough. It's not easy, and it's not a cash grab.
Mike, would you agree with that and thinking about the dynamic of where we're headed into 2018 in terms of who will make up the investor? Certainly, if you look at Bitcoin 2011, it was a certain type of investor. If you look at now and even 2017 to date, it's probably another type of investor. There's some steep Pareto curve in terms of the number of wallets that invest in any of these and their participation. Are we going to see things change, or do you see that in the hedge fund market?
Yeah. So the one I think the market, as Shane alluded to, has traditionally been Bitcoin holders and engineers and a very technical mindset. I think the one thing that's changed is there's been a lot of crypto funds that have been raised. I think the last count something like 120 funds. Most of these funds are essentially basically ICO funds. They invest in ICOs, and I think that mix will change kind of like the investment landscape for ICOs. However, having said that, I think the reality is that like we're all playing the long game, right? We're all interested in what's going to be still around after 10 years, and I think that just like with the .com boom and bust, there will be a few Amazons, a few Googles, a few Facebooks that come out of this, but there will also be a lot of projects which are pets.com or Webvan and others. And so I think the challenge, to be honest, I actually would love for the ICO market or the entire cryptocurrency market to go down by like 5x. That's partially only because I'm running a algorithmic hedge fund, which will predict that. But more so because I think that when the hype cycle dies down and you have projects like the ones on this forum, which are legitimate, which are using the blockchain and smart contracts to create things of real value, it'll be easier to stand out among the crowd.
Let's talk about that a little bit more. So there's a lot of comparisons between what's happening on blockchain and the rise of the internet, and Pets.com gets picked on a lot as sort of a company that should never have existed, which you could debate. But in the current context, there are certainly some companies that are well suited to a blockchain solution, meaning the network is their product in some way, shape, or form, and there's others for whom that model is sort of their business. They're trying to shoehorn an existing business into a model that makes sense to investors. Can you talk about the differentiators between what makes a sort of a company that's suitable for blockchain versus one that's not, or what are the characteristics?
Let me just take a crack at this one because I hear a lot of ideas that they sound good or they're vaporware. We're moving past the prototype phase. Most projects should be pretty close to some sort of network, depending on the scale, but we're moving beyond just strict white paper and a hope and a prayer. So that's the first step. Second thing, there's two big leaderboards. Everybody looks at this ICO leaderboard like it's a thing to raise $250 million in a discrete fundraising event, like that's an accomplishment. No, the real leaderboard is the utilization. Like the utilization of the tokens is really what matters. Like go look at the top market caps, and it's the ones that get traded consistently, often, and up into the right. Like most of those had no ICO. So I would take a look at the ones that are highly utilized, and they seem to correlate with industries that are highly arbitrage, highly optimized, and highly digitized, meaning finance, media, reward points, transactions. It sort of became clear, one of the guys who wanted to be on this panel was a guy who made a robot to take care of old people. Great. He came up with a good smart contract, but his first implementation is, you can pay for your robot with token down the road with a discount. The real bad ideas fall into discounts for services, or you have to move a physical bit, because they don't go very fast if you have to move a robot at the end of your smart contract. So generally when I hear, you got to move physical parts as part of the extension of your contract, or I hear there's really no shot at being utilized and going up into the right long term, I would say those are the two general, I would say, don't really fit. Highly arbitrage, highly optimized industries currently are the ones that are adopting it the quickest. So finance, media, advertising.
Yeah, so I could take another case study in what we're doing, right? And what's a good fit and what's not a good fit. I think that's exactly right. There are a lot of things that are basically just forced utility kind of rent seeking. And so it's like, we normally pay in dollars. Now there's a new funding mechanism, right? Let's use this new arbitrary token that we created, right, and pay with that. And absolutely that is a very basic model that is just basically a funding hack, right? And doesn't quite work long term. More interesting is what you can actually do when you do something like control your own currency, right? So let's take it back a step and see, what do we need to actually have a consumer blockchain killer application, right? What does that actually look like? And we can actually see, like say, what's an internet killer application, right? Facebook, whatever, Google, right? And it's like, in order to have something like that, it has to be something that your grandmother can use, right? Where like, any grandmother can use Facebook today because all of the internet, the backend is abstracted away, right? You don't have to know how HTTPS worked or TCP/IP work, right? It just like works, right? You just see it and like you can act with it. Where that's fundamentally untrue of blockchain today, right? Everything's in like an alpha or beta stage. Very few things are production ready, right? Like even if you look at Ethereum, you can't say it's really production ready, right? It's scale ready and all that. And in order to interact with any of these things, you have to understand how to keep your cryptographic private key secure, what that even means, right? Some random hex string address. All these things that even for a technologically savvy person are a steep learning curve. For someone who isn't, right? It's a non-starter. And so it's like, how do we get to a field in which that's possible? Well, we can do a couple things. And there's a good insight that I got from this guy at David Tish's fund, Box Group, who he said that there are two kinds of companies that he sees really succeeding in this field. And so it's actually reasonably easy to find a good team and find a good product, right? There are good heuristics for that. But it's incredibly difficult to figure out timing. And especially in this market, we can see that market sentiment does not quite align with the underlying potential technologically of what we're working on, right? And this is true of like anything, like the dot-com bubble too, right? You had like this time in which clearly some of the largest companies around today, right? Amazon, Google, PayPal, eBay, right? They all came out of that specific space in which there was huge market sentiment before there was necessarily the correct underlying potential, right? Yet at the same time, they were working on something that had imminent practical value from day one and massive practical value, far in the future. And so what you have is this environment in which you're able to get a significant amount of funding that would allow things like Amazon, right, which has like invested so much money, right, and to get to where they are today, and arguably couldn't have succeeded without this kind of funding environment, right? But that allows you to get to a place where if you're actually working on something that has practical value from day one and large value in the long term, to maybe raise an order of magnitude more than you normally could. And then everyone else, right, in the space, like Pets.com, right, all these people who are working on unrealistic projects, they think this market's going to go on forever, right? This is like the future, and it is, but not perhaps right now. And so what happens is, the market crashes, and then the market becomes irrationally bearish. And then what you have is you're well capitalized, you're working on the real project, you're doing well, and then all your competitors have died off, right? And so now where are you, right? You're one like truly valuable company with a lot of capitalization, 2 orders of magnitude away from anyone else who could compete with you working on something that has real value. And so what that looks like is because the market is irrationally bearish, all your existing competitors have died off, and now all the people who are coming into this market are raising at maybe an order of magnitude less than you could. So there's a lot of potential, but what you need to become is basically a company that can either do one of two things, or ideally both, which is one, maybe you raise enough money that you can outlast this timing, right? Because market sentiment, again, doesn't align necessarily with this underlying potential. And then the second thing is perhaps you're a company that can work in a hybrid model, right? That can work in a world that is both centralized as well as decentralized. And so ultimately, if you can find a way to add value from day one in the centralized world before the fully decentralized products right now are a far way off from being robust, scalable, secure, and reliable enough to compete with a fully centralized world, right? And so at some point that certainly will become true, right? That's just a technological infrastructure barrier that needs to be reached. It's not there yet, but at some point it will. Maybe it's 1 to 5 years out, maybe it's 1 to 10 years out, right? But a company that can raise enough money to get to that point and be well positioned to do that is going to possibly succeed, and a company that can add value today in the centralized world is also going to possibly succeed. So take an example of what we're doing. And so what the insight that we have is, going back to what we talked about before, is with the currency, you're able to align economic incentives in a way that hasn't been possible before. And what I mean by that is, say if you take the US dollar, right, and if there's a finite supply of US dollars in the world, and yet the US economy kept growing, right, in a very highly simplified model, you would imagine that every US dollar should, equate to more buying power over time, right? Maybe the economy, if it just produces bananas, right, and you have 100,000 US dollars, you have 100,000 bananas, then the economy grows to 200,000 bananas. At first, right, $1 US could afford 1 banana, now it can afford 2, right? So you'd assume that every US dollar should have more buying power over time as the US economy grows. This doesn't happen in reality, right? Because the Federal Reserve, right, is essentially the middleman, right, that can actually issue more US dollars. And as you issue more of a currency, right, you don't actually change the market value of the economy, right? But you do dilute everyone who does have US dollars today. So in reality, we have, a 2% depreciation rate, maybe 50% every 20 years or so. But when you control your own currency, you can actually change that, right? You can capture that value for yourself and accrue it, distribute it directly to the people who are responsible for the growth of this economy. So we can create, say, a sector-specific currency, right? So in our case, right, we're having a currency that represents content distribution over time, and specifically at the very beginning, video distribution. And what you can do is, say you start with, say, 100,000 stream tokens, and then there's $100,000 of value that accrues into the system. And to use goods and services on the platform, right? For example, this is exactly what happens today with live streaming. It's a $5 billion industry, very large in China, where it's about $4.3 billion of literally people converting, say, US dollars, right, into, or Chinese yuan into currencies like, Twitch bits or Periscope parts, right? These are virtual currencies, and, you maybe convert one US dollar to 100 Periscope parts, then you give it to some content creator as a tip or gift for the services that they provide, and then that person cashes out and they get 60 cents back, right? And so in this case, you're actually taking a pretty good currency, right? The US dollar is a pretty great currency. You can use it for almost any given service. It holds its value relatively well, right? There's some depreciation, but not much. And then you're converting it into a currency that's actually really bad, right? The Periscope heart is a terrible currency, or a Twitch bit is a terrible currency because one, it can be used for one given service on one platform. It's a liquid. You can't refund it. It doesn't go backwards. And every time you use it, there's a 40% tax, right? And so it's easy to actually say, here's a value proposition. Why don't you use stream tokens instead, right? It's better for A, B, and C, and D, right? And so A is it's infinitely liquid across any single currency in the entire world, right? Because it is cryptocurrency. It's easily transactable. Two, it's something that actually is usable for any given service, right? So long as someone accepts it as payment. And three, there's no fee involved, right? And four, actually, there's a strong ability to incentivize network effect and actually stabilize the currency over time. So we can talk about that more later. But that's an example of something where you can provide immediate benefit today in a centralized world, where we don't have to create all this backend like a wholly robust decentralized streaming solution, and yet be able to say plug in directly on top of these platforms. Like we have a Chrome extension that goes on top of Twitch and Periscope and allows you to basically bypass Twitch bits or Periscope parts and use our currency instead. And it's an easy value proposition to make even without touching on the blockchain, right? No one has to understand the blockchain to understand that value proposition.
Let me riff on that for just a second, Ben. So thinking about or going back to sort of this idea of people. In the startup space, you have people, you have ideas, and you have capital, and you're bringing those together through different mechanisms. And this is one of many mechanisms. The conventional wisdom, I think, in the Valley is when you do a fundraise, you raise with smart money. People who can add when they join your board, people who can bring introductions to you, people who have been in your industry for decades, perhaps, and are bringing some wisdom to you as a founder. Do we lose something in ICOs as we go out and raise with anonymous accounts? People have instant liquidity in some cases. You were paid by Peter Thiel to drop out of Harvard and become a Thiel Fellow, and clearly that mentorship has been important. How do we get beyond that in this model where people are anonymous and you don't get sort of the community support for your startup, or do we?
You actually do, yeah. It totally depends on how you structure these things, right? So, for example, we did exactly that, and we looked for people who had value add beyond just money, right? So we did an advisor round, we did $5 million in the advisor round, and we're backed by some of the major players in the space, right? There's Pantera. There's FPG Capital, which he's over there right now, and we have Fembushi. A lot of these other players who have been, for example, we have Judd McCaleb, right? He's the guy who made Mt. Gox at the very beginning of time, the first exchange, and then he sold it to the guy who made it a crazy K-like thing. But he made Ripple, Stellar, all these things, right? We have Michael Arrington, right, the founder of TechCrunch and all these things, in kind of this round where we were able to capture exactly that value, right? Where we're able to get people who have added enormous value over time, not just on money, but in expertise, connections, and so forth. And so, yeah, you can structure it exactly how you want, right? You can do that. You can go out, you can just get, people who are actually your users, which is another aspect of it that was touched on with the crowdfunding talk earlier, where there's exactly this idea where you're able to get this base of people behind you right from day one that truly understand what you're doing, and arguably is something that was not accessible before, right? So now you're actually opening up this whole new world of opportunity where you can do exactly what you could do before, get these smart connections, but you can also get these people who are the people who really understand and use your product, right? And they can also get behind what you're doing.
Cool. Let's do one more question, then I want to open it up to the audience. And this one's for Michael. So let's talk about the future a little bit. So we have a sort of a current state in smart contracts. If you look at your typical ERC20 Ethereum token contract, it's a couple pages of code. It's not anything complex. To Shane's point, it's JavaScript. You can pick through it. It's kind of, I think, of like 1995 opening up Notepad and writing open bracket HTML, close bracket, hello world, and you render it. And we're kind of at that stage right now. What are we going to see in the future, given the fact, to your point, that we have the capability not just to distribute the ledger, but also distribute the logic? What are we going to see in the future in terms of what smart contracts can do?
Yeah, I think there's been actually quite a lot of hype around smart contracts. Actually, my preferred name for them is actually dumb programs, because they're actually just programs you deploy on the blockchain. But that's also very powerful because if you look at kind of like a very complex legal agreement. So one example is, let's say, is an ISDA master agreement, which I'm sure a lot of lawyers in this room are familiar with. An ISDA master agreement governs basically the risk between two counterparties that are engaged in a derivatives transaction. There's a lot of like arbitrations type, like kind of like qualitative information in there, but there's also a lot of mechanics. For instance, like let's say when the value of something goes down, how much margin do you put up? Like what's your maintenance margin? Like basically, there's like 200 pages worth of like a lot of logic and mechanics. All of that really should be in a smart contract one day. Right now, every bank, every derivatives dealer basically models these things in their own systems, and mistakes happen all the time. Because of that, people rely on third parties, and that can have very negative consequences, as we saw with Bernie Madoff, when basically their auditors just relied on the single financial statement that Madoff's accountant produced. And their accountant was basically two people who were in a mall that were friends with Bernie Madoff. And so that reliance on third parties is what the blockchain and smart contracts will eventually displace. Right now, smart contracts with ICOs it's a one-time crowd sale to many, many people. In contrast, our fund smart contract is designed to allow us to operate the fund over 10 or more years, and limit and give us the ability to limit the number of investors only to the ones who are accredited, but also perform calculations like calculating NAV, allocating fees between the manager and investors, handling daily subscriptions and redemptions, through the smart contract. So we've designed it to be, number one, secure, which means that only functions, most of the administrative functions are only exposed to the manager, not to investors. Number two, upgradable. Because it's an evergreen fund, we need to make sure that the modules in the smart contract can be hot swapped at any point if we want to upgrade them. So we've done that by deferring all the logic of the smart contract to subcontracts, which are called by the main contract. And the third one, which I think is really important, is auditable. So we log every transaction that passes through our fund to the Ethereum blockchain. What that means is you get essentially for free a replayable audit trail from the beginning of time all the way through the end of the fund. And that we're going to use that to basically generate K1 statements, audit reports, everything that traditionally you would hire intermediaries who might be susceptible to fraud for. And I think the future of smart contract and blockchain essentially is that structure applied to every single financial contract we have today.
Yeah, so I can add a little more clarity on that, jumping on that point as well, nuancing it. Where, we have a lot of lawyers here, for example, right? And so, that is a world in which right now we require like a justice system, right, to arbitrate between a lot of parties, right? And so that's essentially a middleman, right? That right now, a smart contract can basically abstract away a lot of those ideas, right? So a smart contract ultimately allows you to abstract away the need to trust a middleman, just like we had mentioned, where basically you can see like Bitcoin as the original smart contract, right, where it abstracts away the need to basically trust the government, right? And if you look at fiat money, it works well over the reasonably short term of history, right? But over time, no fiat currencies ever withstood the test of time. Whereas, for example, that's because you have to trust that the Roman Empire or Babylon or Assyria or Mongolia, right, will always maintain their dominance over time and manage that money well, right? You have to trust that the central bank will manage it well. Doesn't always hold true, right? At some point, that will always fall if you have to trust a middleman. In this case, you have a system that is just governed by code, right? And you can actually see very transparently exactly how everything works, right? So there's there are a couple characteristics, right? One, there's you have to trust this middleman to operate correctly, but also it's a bit of a black box sometimes, right? You don't really know what's going on. Input goes in and then output comes out. You don't really know what happened in between, right? You can change that for the first time. And let's also talk about, I think another aspect is inefficiencies, right? And so there's a large cost associated with lawyers, for example, right? You guys make a lot of money, right? And that's great for you guys, but possibly not great for the people who are using your services so much, right? Until if you guys are providing a valuable service, that's great. But what if there's a better way, right? And so let's take a simple example of like, say you're having a bet with a stranger, right? And like you're betting, will Donald Trump remain president at the end of 2017? And okay, you guys put like $100 into it, right? And like normally in this world, you would have to deeply trust that this other person is going to be an honest character and actually pay you. Because if they don't, then you're out in the cold. What you can do? Well, maybe if you have the written contract, you can go to the legal system, right? But the costs of arbitrating such a small bet are going to be likely much higher than the actual bet itself, right? And so for anything that's below this like economic inefficiency barrier, it's not worth arbitrating. And so then you can't actually capture all this like long tail of like all these things that you can do in the system. Well, take a smart contract. With a smart contract, you can completely obviate that need and actually minimize the cost of basically nothing. So what you can do is you can have a smart contract that says, all right, like Bob and Alice, right? They both want to make this bet, will Donald Trump be president at the end of 2017, and they both put $100 into it, right? And you put $100 into a smart contract, the smart contract automatically puts it into some escrow account. And then at the end of 2017, it can ping an oracle, right? And the oracle can say, oh, who won this bet, right? And like, Donald Trump is still president, then the money goes to Bob, right? All the money goes to Bob. Or if he isn't, then all the money goes to Alice. You have no need, right? You've abstracted the way to need to trust the other party or middleman or anything, right? You don't have to trust that the legal system is going to work in your favor. You know by this code itself that it will, right? Whoever is correct, whatever the oracle says, that is what will happen. And then on the other side, you don't have to trust who Bob or Alice is, right? Like it doesn't matter because you know that money will come to you. And so that removes a lot of economic inefficiency. It removes the need to trust a third party. And yeah, there are a lot of things that you can do with it, even beyond that.
I'm gonna stop us there. You brought up a bunch of interesting stuff around escrow and oracle and other things, but let's go ahead and open it up to questions because we've sort of spewed a lot of information about how these ICOs have been run, and I'm really curious, based on this audience, what feedback you have. I'm trying to read everyone and get a good sense of what people are thinking. Does anyone have questions?
So Ben, when you were talking about how some of these coins are geared towards the actual service embedded, you also brought up Amazon. So could you imagine a scenario where there's sort of Amazon bucks, let's say, that come from an ICO, right? It's non-dilutive capital. It funds their cash flow needs besides what they're generating internally. And since it's used within the platform, is that where this goes, or are ICOs really just going to be used for initial funding until you can branch onto whatever funding mechanism you're going to use next?
Yeah, so at the native state, the naive model there, I would see that more as rent seeking. So that would just be replacing, a working currency like US dollars, right? In exchange for Amazon bucks, right? In that case, like there's no immediate value that Amazon bucks adds. In fact, there's foreign exchange risk, right? And that's a bare minimum risk that is latent whenever you exchange one currency for another, right? Is that there's some foreign exchange between the Amazon buck and the US dollar, right? And so there's some loss and spread over there. And so in that case, like at its native state, I don't see that being the true value of a currency in this space or a token in the space. But there are some ways that Amazon could, for example, nuance that in such a way that there is actually, direct value accrued in such a way that, like, the main question to always ask is, like, why not use US dollars, right? Or why not use Bitcoin? Or why not use Ethereum? Why do you really need your own token? And in that direct case, there's no real clear reason, but there could be if you actually, play with the economics a little bit.
I'll clarify. I mean, make no mistake, there will be public companies that issue tokens, like existing public companies. This is not like, Amazon has a bunch of hardware and a bunch of inventory. Look at Reddit. Look at Zynga. When Zynga all of a sudden makes their premium currency and you can take the chips off the table, everybody sort of starts to realize how much money is going to be made. Hasn't happened yet, but the bigger the tech companies are getting that are issuing tokens, there will be a public company, and all the issuances and further problems that are going to come with that will be resolved in public when Zynga does it. But they're all thinking about it. It's not a matter if, not a matter when. And I think the implementation will be smarter than discounted like services or whatever.
Yeah, so to add one example, that's exactly right. I think in Zynga, there's actually real benefit, right? Because now you have a currency that people are using that is a virtual currency, right? A literal virtual currency, but it has a lot of downsides, right? It's not liquid. You have some like secondary market for it, but you can't directly exchange it for other currencies and all that. So those are real
Playing
benefits.
poker.
Exactly.
Can't
right.
make a living playing Zynga.
Uber have their own currency, like Uber?
They got to move cars, unfortunately. I think there will be interesting slices of this long term that will play on the data that they've accrued over time. Again, that robot manufacturer went from, discounted rates on buying your robot to automatic distributions when the robot part gets put into production and used. Like, there are very smart people that are going to take their business and truly adapt the token technology and not just make it a discount on services.
I have a question and a follow-up question from you. What do you see as an entrepreneur in disruptive technology? How do you get received? I'm sure you guys raise money, but how do you see this thing going to proceed moving forward?
Oh man, I mean, there's only 2,000 tokens. There's only 2,000 tokens. There's millions of companies, and there are millions that haven't been formed that will be formed because of the token technology. I think it's really early. I think hopefully this is my last big tech project of my life because it seems substantial and long-term enough. I hope this is the one and done because honestly, like, I've seen Facebook open, Apple's iPhone open. I've seen, been 10, 15 years. This is the biggest by far. In terms of where everything's going, the overall trajectory, the overall velocity, and we're very lucky to be very early. But it's also incredibly damaging when people perceive us as marketers and like, it's just early. It's like us describing HTTPS in '94. Like, you're talking about the future, but we're very early. I would say very optimistic long term because businesses will learn to utilize these tokens, and we're just the ones who are at the early precipice of this. So you guys will eventually issue tokens if you're VCs, if you're lawyers, if you're just not
I
yet.
saw a hand in the back first, and then we'll come up to the front.
Okay.
No, hi, great project, great, great panel. You guys have great, amazing stories, and I'm sure you're very successful. Question for you regarding, probably I'm directing this towards Michael, but the others can chime in. We're in a similar space of launching an ICO. Do you have any ideas for if you have multiple phases of the long roadmap regarding your total supply and your initial available supply? Or would you just do 5 separate ICOs, but now you have 5 different coins that basically have 5 different potential utilities instead of using one? Any thoughts?
Yeah, the question just for the camera was in terms of the roadmap, and do you phase a single coin or do you have 5 different currencies roll out? I think this is also more broadly something that Antonio talked about this morning in terms of concerns investors have about dropping a big bag of cash on top of founders who haven't yet performed versus having payout over time on milestones.
So I'm actually probably the wrong person to answer this question, mainly because our tokens, while mechanically they form like an ICO, they're just backed by a trading strategy that's liquid and mark to market on a daily basis. So it's not, I guess, we basically are fortunate enough not to have to worry about valuation.
I have a question. Can you
Hi, Blaine from Folio. I'm kind of in the plumbing business, financial plumbing. So when you talk about escrow, I'm super tuned in and would love to hear your thoughts on where it's at, recognizing, like Shane said, it's still really early.
So the question was about escrow and what that looks like in ICO space.
Yeah, I think there's a lot of legal ramifications as well as technological ones, and so it's not just can we feasibly do this technically, which is possible to a certain extent, but also what's the legal ramification of doing so, and that hasn't been clarified to a degree that people have unmasked done this, right? People are certainly working towards this, and it seems likely that this will happen within the next 1 to 3 years, where we'll see initial use case and adoption cases for this, but it's not something that people are using directly quite yet.
Yeah, so just trying to, I think like things like escrow and clearing are really great fits for smart contracts. The issue is more that it's in order to participate, you essentially need to enter with, let's say, Ether, and exit with Ether. And so we're actually running into the challenge as well because essentially it's not that we don't want people to give us lots of dollars, but ideally they're the ones who are managing the Ethereum, taking custody of their assets, and so they're really leveraging the true power of the blockchain. And so I think escrow is a great idea, and I'm actually surprised that there aren't more blockchain companies that just focus on escrow. But I think the issue is that if the participants are traditional financial players, they need to be comfortable with transacting via Ether.
Yeah.
Just follow up the question of where you see the ICO market, and you mentioned that lawyers and everyone will be issuing them. Do you see, as the market going forward, the vast majority will be some sort of investment, whether it's technically a security or not, and nobody's actually using these utilities in the vast majority of time. There is a difference between here and 2000, where at least in 2000 people were selling interest in their companies. Here they're selling interest in like the club, and it is different. And I wonder if you see the market.
I want to take a run at that one. So I think today, and maybe this I'm paraphrasing something you guys said on another panel, but I think today we do have the equivalent of utility tokens out there. It's our airline miles, it's our Avis points, it's our Marriott miles, it's our Starbucks balance. It's all of these things that are out there. And to Shane's point, I think it's agnostic to the stage of the company where these things start to add value. When you start to get good performance off of the network, you have an immutable ledger, you have something that can be out there. So I think we have the substitutes already in play in the market today, such that the utility token will exist. For the camera, your question was more, what does that balance look like? Do we end up collapsing a lot of the current ICOs back to securities anyway, which I don't have an opinion on, but I do think that we have a proxy for what would look like a utility token widespread across all the Fortune 100s today.
Or if you'll have utility tokens on one side, which will not be about raising money. I mean, nobody raised money with Starbucks cards. You're not allowed to trade your miles for real. We have utility tokens being the pure utility with just whether it's tracking or not, and then the ones that are raising money will be the security tokens, and you'll have a pretty big divide like you have now. I mean, you have all these points and miles, but none of them have active legal secondary markets, and none of them are used to raise money. Is that where you see the market going?
Yeah, I can take a crack at that. I think you're exactly right. I think there will be a segregation between security tokens and utility tokens, but I do think that there is a market for both, right? Just like that example with United Miles, right, or like airline miles. I think that's a perfect use case for blockchain, where airline miles are a huge industry, right? And people do actually, like, banks pay billions of dollars for airline miles, right? Yet they're a horrible currency because it's incredibly deflationary over time, right? Like, airline miles today are worth far less than they were back in the past, and that's because it's an arbitrary system, right? That doesn't have any transparency in how these inflate over time and so forth, right? And that's something that blockchain can easily solve. And so there is clear value in those utilities over time, but absolutely at the same time, right? It will be something where there's more regulatory clarity in how they use this as a funding mechanism, and we already see people who are working directly towards that goal, right? Of having a very regulated, securitized model for using this to represent securities as opposed to utilities.
Yeah, if you have data, I think you guys all are information and data barters to some degree. I've heard a very pithy statement from somebody smarter than me that if you're ever at risk of government regulation or censorship, you might likely find an application on the blockchain. And it's true. I mean, I deal in media. Guess what? Censorship's rampant. Like, you guys deal in client privilege communications and all kinds of data. You will be struck with the idea at one point that maybe this should be immutable, and maybe you should grant access based on who has the token. Just putting that out there.
Thank you very much. And
All right.
programming note, tomorrow we have a workshop about if you like to be ICO. Now you want to be ICO, handling by Joe Lasso. But I want to thank you guys come all the way there, Cameron.
Thank you.
And I live in Silicon Valley, and this is what I call, no offense to the people here, a lot of smart people here, I call it smart panel. And I live in Silicon Valley. Half of the time I need to hire a translator to see what you guys talking about.